Katrina, and then that was, I remember being a young analyst then, and like everybody was pretty bearish at the time, or not everybody, but the bearish people, the cynics were. And I remember being like, you gotta wait, this hurricane's gonna add a couple points to GDP, and it did. Like post the hurricane, it gave it a couple extra quarters of like, and we got that most of 06. They hung on between credit card and whole cash out refi spending, and then the hurricane rebuilding. All I'm saying is I bought the Generac last week, remembering 2011 or 12, whatever the hurricane year was in New York, and then also 2005. This thing's the hurricane stock.
Okay. Yeah. And you saw a dip in the property casualty insurance companies, and you saw a bid in some of the home builders, as you said, in the Southeast. So yeah, people are playing the hurricane effect.
Well, hurricane.
Let's get started. Welcome back, everybody, to the Wall Street Beats Roundtable. It's October 9, 2024. I'm your moderator for today's session. I'm Paul Meeks, one of your tech voices on the program. But I have some real smart dudes adding value with me. We have Robert Marson. He's going to talk today about an interesting manufacturing technology test stock. Ben Bry, the wild man. He always has some interesting thoughts. I saw some repartee this morning in our chat about what happens with Google in a breakup. We have Bob Morris talking about writing some calls on various companies in the oil patch. And then, as always, our financial guru, Charlie Peabody, talking about a couple of major marquee New York money center banks that will be reporting their results Friday morning before the open. So let's get after Robert. Tell us what you have with this very small cap stock, but small cap stock brings big opportunity, perhaps.
I apologize for the nano cap stock, but it is a very volatile trading stock that overreacts to positive news and negative news. So that means it gets very expensive and very cheap. And I've mentioned it in the past as though I put it in my stock list. I bought a very small amount. It's a company called Intest. It's a $7 stock. It's about a $80-90 million market cap. It trades at the bottom. It trades difficult at the top. It trades as much as anybody here could sell, including institutions. So the liquidity is not a problem when you're going to sell. It is if you're right. If you're wrong, the liquidity is an issue too. But if you're right, there's no problem selling it with a large profit. So the company makes its business is it's like an industrial conglomerate or a technology and engineered system conglomerate for mostly semiconductors, RF and power semiconductors. The analog market, their biggest customers are analog devices and Texas Instruments and Raytheon. So they're in electronics for defense. They're in automotive, particularly EVs, with battery testing systems for EVs. A lot of their semiconductor business goes into is silicon carbide based, which has been heretofore a strong growth market for the semiconductor business. The analog guys are digesting the boom bust from COVID, so they've slowed down their capital investment in silicon carbide or delayed it, pushed it out. They haven't canceled any of these new fabs. They've just pushed them out. So this company sort of has had a wild ride for the last 2 years. I owned it at 6, sold it at 16, bought a bunch of it back at 9, sold that in the 20s, and that's all in about 5 years. And now it's back to 7. So at $7, here's what it represents. It represents an opportunity to double or triple your money in the next 2 years if they turn the business around and reacquire peak sales and peak profits. And for them, they had made over 35 cents or 30 cents operating profit for a couple quarters. So the run rate has gotten up to $1.20. I don't expect $1.20 next year, but I do expect sales growth. And I do expect an earnings recovery, because this year is going to be around 40 cents per share. Next year, I expect, around 60 cents to 70 cents in earnings if if we're fortunate and they execute well. And then the out year, I expect them, if the economy hasn't gone into a recession, to make well over $1 again. So on that dollar, these companies, when they're in their upcycle, trade very richly, and should be $15 to $20 again if they're making north of $1. They're back at their $1.25 earnings per share level. So it's it's down, it's cheap, it doesn't have the current good fundamentals. It's gone into that turnaround category, Paul. We all know, everybody here has invested in turnarounds. They always take longer than you think. You always think they're going to turn around because you're smart and you pick the bottom. And I don't know if I'm picking the bottom here in the business, but it sure feels like the business has really gotten negative in a couple of their deep cyclical businesses. And I suspect a year from now, we'll be looking at a new upcycle for the likes of Texas Instruments and Teradyne and Analog Devices. And those guys will be investing more heavily in test product line.
Yeah, Robert, in the meantime, what's the balance sheet look like? Do we have any support there? Is the company generating free cash flow?
The company is conservatively financed. There's $21 million in both short and long-term debt, and there's $20 million in net cash. And they do have excess inventory because of the down cycle that they'll be drawing down into cash over the next few quarters. And they do generate historically about $1 a share in free cash. So it's an engineering company and an assembly company in test and measurement and process equipment. So they don't have big factories with big machine tools or any of that kind of stuff. So their CapEx is a few $1 million a year. So every year, all of their net income is essentially free cash flow. So when they make $1, it's $1 of free cash flow, and it's $7 stock price. You have a 15% free cash flow yield. Balance sheet is strong. Management has a good pedigree. They've been there a few years. They came from some very strong companies in the industrial area. Amatec is a Philadelphia company. They came from some of the German manufacturing companies. So the CEO and the CFO are very bright guys with strong pedigrees from high quality companies, Emerson Electric background, that kind of a thing. And they know how to run businesses. They've just been clipped by a very deep down cycle in the capital spending for their niche end markets.
Well, we'll have to hope that there's at least some excitement in the name, because I see the last couple of weeks it's traded only 50,000 shares a day. And your theory is that people get more excited?
No, my theory is the opposite. See, I appreciate that question, because the stock's at the low end of the range. They went through the institutional face loss selling period by the end of the third quarter. You guys know what that is. I don't have tax losses, but I don't want to lose face by showing this in the portfolio. So it's a face loss sale when it's a non-taxable institution that sells it. When a retail investor sells it, it's a tax loss, okay? Face loss selling peaks in September. Tax loss selling peaks in October or November. Not the last week of December, as most people think. And I assume everybody says, look, I could sell this now, or I could hold it into the holidays and sell it at the end of the year when everybody else is going to sell it. So I'm going to get a jump start on the year-end tax loss selling, and therefore it peaks in November or the end of October. So I expect the stock, if it's weak in any bad market environment, i.e. Our little plungette in October or post-election concerns, I think this could trade down to 6.5. And I would be very aggressive if in a period of tax loss selling, it would drop. I have about a 1.5% position in the stock. I did keep a small position when I sold most of my stock in the 20s. And I also bought a small position a couple months ago at 10 and change, and that turned out to be premature. So my next move will be to fill it out into a more normal position. And I had a 5% position in this which is kind of big for a small cap company for me. The last time it took off, so this company has paid for my house at least.
Good. Well, Robert, I must tell you something from the heart. You were one of my favorites until I saw your Philadelphia Eagles jersey today. Yeah. So anyway, you're off my Christmas card list, brother.
Sorry.
All right, let's go to Bob Morris. You playing some derivatives in the oil patch? Tell me it's not so. Turn on your ball. Hello.
Technical difficulty.
You're on mute, buddy.
Yeah, sorry about that.
Yeah,
I got it off now. You can just hear me and not my dog.
That was the smartest thing you said, Bob.
You were looking good in the intro.
Yeah, thank you. So last week when these energy stocks had run up on the spike in oil prices following Iran's sending 181 missiles into Israel and Israel saying they were going to respond, I said then after the stocks had run up that I was not inclined to chase them. And if anything, I was looking to maybe write covered calls, out of the money covered calls and on a portion of my positions on any further strength. And so Monday, EOG, it ran up to 135. I didn't pull the trigger Monday. I should have. But then on the open on Tuesday with the news that China stimulus they may not have another round that would keep everybody happy. Oil started to come off. So on EOG, I quickly, on a quarter of my position, wrote January 141 calls. And this is something I like to do. When a stock is run up and I can write 10% out of the money strike calls and get a 3 to 4% premium, I like doing that. So what I was able to do is I was able to get $4.80 for writing 141 calls. The 140s don't trade in January for some reason, but I had to write the 141 calls, collected a nice premium, and did that on a quarter of my position. Now, the thing to keep in mind is part of my view here is that if oil prices for EOG to really run significantly above 141, we need oil prices run up very sharply here and like to $95 a barrel and stay there. And I think over the next year, we're not going to be at $95, $100 a barrel for the next year. And it could be a situation like with the Iraq war, if Israel attacks Iran, that you get a spike in oil prices, comes back down. You've got two things here to keep in mind with that retaliation in oil prices. One, is Israel going to attack their oil facilities, or are they going to attack their nuclear facilities, or are they going to attack the Revolutionary Guard headquarters and bases? I think they're more likely, this is my opinion, I think they're more likely to attack the nuclear facilities rather than the oil facilities. But if they were to attack the oil facilities, remember, Iran exports about 1.7 million barrels per day of crude oil. And what OPEC Plus delayed in putting back into the market by 2 months, now supposedly beginning at the end of November, is 1.65 million barrels a day gradually over the next year. But they said they could accelerate that or defer it further, do whatever they needed to do. And Saudi sort of pledged here to keep the oil markets well supplied. So it's hard for me to see oil staying significantly higher over the next year. And so I think writing these 141 calls out in January makes sense. Now, the other thing to keep in mind is that if the stock's at 142, I'm not letting the stock get called away. I'm rolling these options. And that's what some people forget. That, up to even 165 in the stock, I can roll the 141 calls another 3 months and collect another very nice premium. And I can even collect a premium in rolling up to strike at that point to maybe even 144, 145. So I can continue to collect premium in rolling those options. The only time I give up and say, you know what, it just doesn't make sense to roll them is if the stock's like above 175. At that point, it's likely where the break-even point is. And I say, okay, it just doesn't make sense to roll them anymore. And then I'm watching what the stock does with where oil prices are. And then maybe I look at, replace that 1 quarter position by writing puts at some point or whatever. But I think it's a very good strategy given the view that oil's not going to run up to 95 and stay there for the next year. The stocks run up here. I can collect a very nice premium, 3 to 4% premium for 10% out of the money strike calls. Now, I'm continuing to watch these names. If we get further strength, if we do get that attack and oil spikes up, then I'm looking to do it again on maybe another quarter of my EOG position. Maybe the next one name I'd look at would be Exxon on a sharp run up in that. EOG and C&Q are my two largest energy positions. I'm not looking to do it on C&Q right now because I really like the deal we talked about that C&Q announced on Monday in acquiring Chevron's Canadian assets. So I sort of want to see how that plays out and see what they say on their earnings about that. So I'm really looking to do it first here. I did it yesterday on EOG, and so EOG and Exxon are top of my list on any further strength, or if we get a big spike in oil on any attack, if they do attack their oil facilities. That's what I'm looking at here.
So they're obviously going to be driven by macro factors, particularly the price of a barrel of oil. But when do the companies actually report their next quarterly earnings?
Yeah, EOG reports in 29 days, and
Yep.
the stock's been very strong here. So, that's one thing we're watching too. And they tend to report very good numbers on their earnings. So, if we get a run up to, if the stock runs up to 140, 145, then I'm looking to maybe write 170 calls out another 3 months on another quarter of my position.
Yeah. Collect some premium.
And it's
All right.
nice premium. There's a lot of vol in these energy stocks, and it's something I think it makes sense. I like doing this.
Well done. Ben, what say you today?
Morning, boys.
Morning.
I'm talking about PayPal today. So one of the things I did when I was in grad school, I was in a PhD level course, and I had to build a quantitative trading strategy. And I had a strategy that was essentially based on accelerating momentum, but then you had to condition it on value and quality. So it was basically like trying to find positive accelerating earnings growth and fundamental growth, but then with the idea of it had to be over a 5% free cash flow yield, positive margins, no net debt below 1.5 times, and no major debt refis. And then I tried to also find guys who were buying stock back, but that wasn't an explicit. So PayPal kind of matches that. If you look at the chart, maybe we can bring the chart up real quick. You see a stock that's basically, that's the P's, but you can see relative to the industry, relative to the market, it's really cheap, right? So, basically you're talking about a market that's at 21, 22 times. It's an $60 billion company that is starting to see some positive fundamental momentum. They did a deal with Adyen. They just announced a deal with Amazon to be able to purchase. Everyone saw the Will Ferrell commercial of increasing purchasing ability. They just did a deal in China. So this guy, Alex Christ, who's their CEO, is starting to see some positive, results. And their earnings have started to accelerate. And, it just strikes me as okay, this is 16.5 times. Then we layer on the antitrust case against Visa, which has outlined how Visa's done many things to, disadvantage Square and PayPal and any of the usurpers in their mind. And you just see a situation where these guys are buying 20 million shares of stock a year back. They have about a 6%, 7% free cash flow yield. And I could see earnings estimates growing higher. Now, I'm not an expert in payments, and I wouldn't claim to be the axe on PayPal, but this came up in my trading strategy that I run, that I've had since grad school, and it's good business. I think everybody knows it. They were hyper aggressive in gaining share and taking negative intercharge, and thus the stock got smashed. It used to trade at, let's see, in Bloomberg, 30 to 60 times multiple. It's at a 16 times forward multiple. Yeah, and it's a good business with net cash, positive fundamentals, increasing, and then the big behemoth might be vulnerable. So, just strikes me as the kind of thing, as I was looking at this at 60, buddy of mine owned a big position in it. And I kind of just, I got to wait. And to the spirit of this trading strategy is, it's nice to let it start working, right? So I don't mind. Yeah, it's up 30%, 35% since earlier this year when it traded at 12, 11, 13 times earnings and a little bit less earnings, but it's starting to work, and they're incrementally adding positive deals, and they're doing probably the right things. And again, 16 times for a business of this quality is pretty good. In a market that's 22 times, it strikes me as the kind of thing you might want to own.
Hey, Ben, this looks like also a CEO catalyst. How long has that guy been on the job?
I don't remember exactly when he came in. It was a couple of years ago, but he's been active in doing things. And it does, to Robert's point, turnarounds take a little time. You don't just get in there and snap your finger and say, "Hey, I'm Robert Marson. Let's just make more money today." You know what I mean? Like, although Robert might be able to do that, I don't know.
I do expect when I buy the stock that they suddenly get far more intelligent and competent, but that rarely happens.
Yeah, when I buy Robert Marson stocks, I don't get any more intelligent. I don't know what's going on there.
That's that gap between expectations and reality.
We must have gone to different grad programs, because when I was in grad school, I played rugby and drank too much. I don't know about you.
I played basketball in college, so I took it on myself to create the best intramural team I could, and we had a lot of big guys in my grad school, so I did a little sports too. But yeah, look, the point is that I like charts that they crash, then they flatline for a while and just kind of sit there, like Alibaba, right? Kind of the same kind of concept, and they run out of sellers. And then you get some new management change or new ideas. And if the business isn't broken and there's things they can do to add incremental value, maybe enter new markets, maybe cut costs, there's different things different guys do. But that's where you can see a very asymmetric bet on stocks where there's not a ton of downside. Because again, the quality factor of they make money, the valuation is not ridiculous. All the growth managers are long gone, but we'll wait to sell our shares back to them, like we did with Baba last week and 2 weeks ago. It's those guys will come back as they always do.
Hey, Ben, this is not my area of expertise in terms of charting, but first of all, I do like the fact that this stock had based since 2022, and they say the wider the base, the greater the space in terms of the upside. So I like that.
I love that.
So, but short term, this thing broke out at 67, 68. So you can see a breakaway gap on the chart there. And then around 74, there's what we call a measuring gap. And then just recently we had what is called an exhaustion gap at 78. So short term, I'd be a little bit cautious, but I do like the longer term chart here.
Yeah, I'm not saying, hey, go all in today. What I'm saying is that the physics of this look pretty good. We're starting to have that ramp up, and if they can continue to have fundamentals go the right way, then you can get the ultimate duo for equity investors, which is earnings revisions positive, multiple expansion positive. And that's how you get, and then you start getting more ownership. And we all know how this market works. The more market cap you have, the more flow you get, right? So there's a self-fulfilling positive feedback loop that happens. And let's be clear, like so many guys are just momentum junkies that when things start working, they're there. And so this isn't like some small cap, right? This is a large company. This is 80 billion EV or 70 billion EV and 60 billion market cap, something like that. So I think it's worth taking a look at. Everyone can do their own work, but it clicks a lot of boxes for me, and it's something I'm going to continue to do more work on. So I'll be back on the show talking about it, but I thought it was worthwhile to flag, independent of, maybe in the very short term, it goes back to 75, 70 bucks. I don't know, like that's beyond me of like what the exact's going to happen in the next week or two.
Yeah. Well, you got to be contrarian to make some dough. Hey, Charlie, why don't you continue to control the conversation? Tell us a little bit about what Jamie Dimon's going to say Friday morning.
Well, I'm going to mix it up on you, Paul, here, because I'm on the show again tomorrow. So tomorrow I'm going to talk micro about JP Morgan and Wells Fargo. But the bottom line is that the financials are the first out of the gate to report third quarter earnings. And it starts Friday with Wells Fargo and JP Morgan. So today I'm just going to set up the higher level trends that I'm expecting. And then tomorrow I'll go into the micro of those two banks. But the bottom line is the financials here in the third quarter are going to be the worst reporting sector of the 11 sectors in the S&P 500. And then within financials, you have the banks, which is going to be the worst of all the financials. You have capital markets, which are going to be the best of all financials. You have insurance, which is second best. Then you have fintech, the third best, and consumer finance is, sort of the not much better than the banks. But the banks are going to be the weakest of the group. Now, the combination that gets you there is you're going to have no revenue growth, which is a function of net interest income or top line revenues declining, offset by strong fee income, such as investment banking and mortgage banking. You're going to have no positive operating leverage, and you're going to have higher credit costs. So this quarter is not going to be the quarter that is going to get people excited about banks. But what we all know is no one's going to buy or sell these stocks based on, the third quarter earnings. They're going to buy on what the companies say about the future. Typically, we will not get any sort of guidance on 25 here in October on the earnings calls. But we will get guidance on the fourth quarter and the full year 24. And people use that as sort of a jumping off point to solidify their 25 estimates. And the bottom line is that the investment community believes that this is the worst quarter for the banking industry, and it's going to get better from here. In other words, we're going to start to have year over year earnings growth for the first time in the fourth quarter. And so there's a constructive optimism around banks, particularly regional banks, going forward on that belief. Now, there are two things that are inherent in those forecasts. And one is that net interest income will ramp higher as the Fed cuts rates. And the other is that we're going to have a soft landing, and so credit costs will start to come down. Those are two critical assumptions. And I'm in the camp that says NII is not going to ramp up the way people are expecting. So for next year in 2025, most models have net interest income rising by a mid-single digit rate. And JP Morgan earlier in the month warned against expecting such robust growth. And I'm in that camp, that I just don't think we're going to see that. And secondly, I'm still in the camp, and I know this is going to sound heretical, I'm still in the camp that says we are likely to face a recession next year. And therefore, we have not seen the worst of the credit cycle. So while, companies will talk constructively and cautiously constructive about 2025, I think as we get into, let's say the January, April period next year, there'll be a reassessment of how constructive 2025 is going to look. So I'm not a big buyer of bank stocks, but if you want to play the momentum, the short term, what's happening and what's working right now, people are rotating into the regional banks because that's the play on reduced credit concerns and improved NII. So I leave it there, Paul.
Well, Charlie, I'll tell you something. It's maybe a coinkydink. Tonight, I'm going to be with the CEO of Comerica.
Oh, okay.
Yeah, they're having a local event. I'll catch you out offline so you can ask me some good questions to ask him.
Yeah, I mean, Comerica is not one that people generally like. My two favorites, if you want to play the regional banks, would be M&T Bank, symbol MTB, a high quality, well-positioned Northeast regional bank, or Citizens Financial, CFG.
Charlie, I got a question as to the housing price market. It caused the last great financial crisis. And today, I believe the median home price is higher as a percent of the median income than it was in 2005 and 2006. Why isn't the mortgage market causing anybody any consternation anywhere in the financial world?
Well, it should be. Let me separate. From a bank point of view, the banks have been very, very cautious about underwriting mortgage loans. I mean, they're sticking to a 60% LTV. And given the inflation in home prices over the last decade, I don't think it's a credit risk for the banking industry. I am a big believer that we are going to see deflation in home prices because affordability is just untouchable for a lot of players right now. And so that means that home builders either have to cut their prices, which is going to hurt gross margins, or they're going to miss their unit volume goals. So I am a seller and even willing to short the home builders. Now, I know that's heretical because everyone says if you look at household formation going out a decade, we don't have enough housing to meet that, simplistically stated. But I think there is going to be deflation in housing, and so I've stayed away from those home builders as a long competitor.
But the banks are safe. Even if
Robert.
there's significant deflation in housing, the banks are safe, relatively speaking.
Yeah, I do believe the banks are safe because they have done such a great job of underwriting conservatively.
Thank you.
So I don't. But the bottom line is I don't see another 2008 banking crisis. I think it manifests itself more in a negative wealth effect for the consumer, and that will part of my thesis as to why I think we're going to have a difficult 25, 26.
I want to make a comment on the mortgages real quick. I think the one thing for banks that has to be worrisome is, I was just looking actually randomly at the bank balance sheets consolidated of the country in the U.S., and they got $6 trillion of mortgages. And we've seen the distribution, I put it up, of where the rates are struck on that, and 60% is below 4%. But if we were to get a low rate environment, a deflationary environment, as he said, and then rate vol comes down, so mortgage spreads come down, well, if they have to refi those, if people, prepay, it's a huge loss of income for the banks, right? Like, that's just another hit to net interest income, right, Charlie?
It would be. Obviously, the bigger issue is what does the deflationary environment suggest about the broader economy? And in a recession, you're losing jobs, and so I just don't see a robust housing market in that kind of environment. But you're right, it would be a negative for NII for the banking industry. That's a good point, Ben.
Well, gentlemen, appreciate your efforts as always. We're going to call it quits for the day. I'm your moderator, Paul Meeks, with four dudes that are smarter than me. Ben Bry, Robert Marston, Bob Moore.
Not so, Paul. Not so.
All right.
Thank you, guys.